Welcome to this week's Money Fit Live webinar on consumer credit trends for 2021. My name is Todd Christensen, Education Manager at MoneyFit and author of Everyday Money for Everyday People. Thank you for joining me. Here is what we're talking about today. We're going to be going over what has been happening in the world of consumer credit since 2020 and what we're looking at going forward into 2021. The buy here, pay now phenomenon, the what's going on with credit scores. Are they going up? Are they going down? Credit reports. We're going to talk about interest rates and how those are performing or where they're going, where they've been recently. We'll talk about the balances on our debts, and then we'll look forward to see what is coming, likely coming 2021. Let's get right into it. Buy now, pay later. Now, this, if you haven't heard of this yet, you will soon. This is a new product. It belongs to the realm of what everything old is new again. It feels a lot like a mix between layaway and credit. You can pay for it later, but you get it now. It seems like it's just credit cards as well. Here's what happens. You go into a store. Not all stores are offering this, by the way. But you go into a store where you can make a major purchase, and they will, if you have an app, there are several apps, and I'm not going to go into which one is better or what even the names of them right now, but there are 3 or 4 big apps right now that you can download onto your phone, connect them to your bank account. There's no credit check. They don't base their interests on, or they don't even charge interest. This is how they promote it. They say, hey, no interest. You can walk out the store with your major purchase today. All you have to do is pay 25%. That's your down payment. Basically, they take the total purchase and they break it into 4 equal payments. You make one payment today, a month from today, you make another one, a month after that, you make another one, another one. This is really convenient. They promote that they promote themselves as no interest, minimal fees. Some have no late fees. Some have very minimal late fees. They don't have overdraft or anything like that. They do have limits, how much you can put onto your account. You have to sign up. And let's say you make a purchase today, make a payment today, a month from today, you miss a payment. Most likely what's going to happen is after a few days, you'll start to get, even before your payment's due, you will begin to receive reminders. Hey, this payment is coming up. You can probably take that purchase right, or that payment right from your bank account, or you can make the payment through the app. If you don't make the payment, of course, you're going to be shut down. Your account will be shut down. What will likely happen at some point is it will go through to collections. If you're not making payments, your account will eventually end up in collections. If they don't charge an overdraft fee or a late payment fee, they're going to figure out some way to get their money. This is not an opportunity to buy whatever you want and not have to pay for it. You have to pay for it, and if you don't pay for it, there will be consequences. And yes, there will be consequences on your credit at some point. They do say, hey, we don't check your credit. So up front, there's nothing going on. But if you don't make the payment on time, there will, just like if you miss medical bills and other things that don't check your credit up front, if they end up in credit, it will have a negative impact on your credit rating. So check your credit. No. Affect your credit eventually, possibly in a negative way, no positive way. It's not going to positively affect your credit. So here's the overview. It is very convenient. You can buy what you want, pay just a small amount of it now, pay the rest of it later, but it comes at a cost. It's phone-based. That's the convenient part. Minimal fees. Check the fees. Their fees are going to differ by app. Downloading the app is free. They want you to download it for free, and then they want you to use it. and then it will end up in collections, as I mentioned. Now, what's the danger here? Why? Besides, what if you just know that you're going to make your payments on time? Well, if you decide that you're going to use these buy now, pay later options, you may make your payments on time, but be aware that this is a way of inducing consumers to make more purchases. The easier you make it to buy on credit, the more the consumer is going to buy. Who is this a win for? Now, it might be a win for some consumers in some people's eyes. It's more convenient, fewer fees. You don't have this revolving credit card debt. You have to pay it off every month. And that, to an extent, I believe is true. The danger is you're going to overspend. Banks are the real winner, the merchants are the real winners here. They are going to have to pay a fee for the to these apps, the networks that use these apps. They're going to pay fees for that, but in the end, they're going to sell more stuff. That's what this is really about. They sell more stuff, you buy more stuff, you collect more debt. Even though it's only 4 months at a time, you are collecting larger amounts of debt all the time. It's not revolving, you're paying it off in 4 months, but the larger that debt gets, that amount of debt on these apps get, the harder it becomes to make your purchases on time every month. So there's the cost. It's likely that it's going to lead to a lot more debt for consumers, and eventually stuff going to collections. How about credit reports? What are some of the things that we've seen with credit reports over the last year? And we'll talk about where I think they're going before the end of this webinar. They've hit record highs. In 2020, Experian, one of the 3 consumer reporting agencies, reported that their FICO score had hit an average all-time high of 720. That is out of range of starting at 300 down up to 850. 720, that is, as an average, that's pretty darn good. Think about it this way, it's up, in the last 10 years, it's up from 689, that's 21 points, or over 3% in just a decade. What is going on here? Now, over that time period, credit reports were going up, or credit scores. They have been going up consistently since the late 2000s, early 2010s. It's not just an effect of pandemic and stimulus and that sort of thing, although that has played a role. Much of this is just since the Great Recession. There has been a greater awareness of the importance of managing our credit and keeping our payments on time. Pretty much everybody knows the consequences on your credit. And when I teach classes in the community or online, everybody freaks out about collection accounts, and they know how important their credit is. They want to protect their credit. It's almost a fixation that we have in this country about our credit. It has been going up, but it's really gone up even more just in the last year since the pandemic hit, and especially since the stimulus payments from the government started to hit our accounts. The purpose of those, according to economists and government politicians, was to give money to consumers so that they could spend it on their needs and keep the economy going. That was not the case in most households. Most households use it for one of 2 purposes, not spending. That was third. Spending that money came in third place. Most households used it to pay down debt and save, put into savings. Saving, that's really common at the beginning of recessions. When any time we head into a recession, we all buckle down and say, hey, wait a minute. I don't have to be spending all this money on consumer stuff. I can live without all these extra purchases. So that's what we did. We looked at our savings, looked at our spending, and we decided we need to save more. And that's really what happens. That chunk of households, though, that used their stimulus to pay down their debts, that led to a massive pay down of overall debt on credit cards, the lowest amounts we'd seen in years as a percentage on record, as far as I understand. And that has continued thus far. We are still keeping our credit card debts way down. Now let's talk about credit reports. At some point, we're going to normalize. In 2021, we have the vaccine coming. We have return to normal economic activities. Businesses will be back to normal capacity at some point. Sports activities and gatherings, so forth. In the meantime, though, we're still dealing with the pandemic. And since last year, I believe it was March of last year, of 2020, the three main consumer reporting agencies or credit bureaus, Equifax, Experian, and TransUnion, all voluntarily offered all Americans the chance to get their credit reports for free, not every 12 months through annualcreditreport.com, as has been the case since 2004, when the law went into effect that we all get credit report every 12 months from each of our consumer reporting agencies. No, they said you can have it every week until April of 2020. That is the case. You're going to be able to check your credit. You can still check your credit report every week from all three consumer reporting agencies. And checking your credit, just to dispel a little myth, does not affect your credit rating. A lot of people are afraid to check their own credit because they think it hurts. No, it does not. It does not. It does not. Please get the word out. Checking your own credit does not. You want to see what's on your credit, who's looking at your credit. It will help you in your decisions on what to do, if you need to react and fix things, or if it's going in the right direction. But so this will come to an end at the end of April 2021. Will they extend that? It's possible. It was voluntary. The reality is, people I talk to don't even know that you can get it for free every week. So it's not been the potential drain on resources that it could have been for the consumer reporting agencies. They may well say, hey, it wasn't that big of a deal. We might continue. It's not huge demand. But that also dilutes their product. They are in the business of providing free credit reports to businesses and to consumers as well. So it's unlikely. I don't expect it. It'd be wonderful if they did, because it does help to look at your credit and get that full credit report. Not just like if you go through some of those apps where that gives you your credit score and it tells you, oh, it looks like you've got a little more debt than you did last time. Those are summarizing all your debt. The consumer reporting agencies give your full credit, who you owe money to, when it was opened, what the current status is, what the balance is, any late payments that you've had, and how late the payments were. Very detailed. You want that information. What about interest rates? Interest rates, they have been at just all-time lows. As the economy rebounds, we expect it to start rebounding by the end of 2021, what's going to happen to those credit rates? Well, they have been at these record lows. They have been so low. You think about your mortgage interest rates and refinance interest rates. They've been so low that it's lower than the average inflation rate on most 10-year periods as far as this records have been kept over the last 120, 150 years. That means that as the economy rebounds, if you have a home, you've purchased a home or refinanced your home, and your interest rate is below 3% or 2.5%, right now as a recording of this webinar, they are somewhere between 2 and 2.5% in many cases. That means that over time, even with interest, you're essentially paying less for your home than what you paid for it up front. Because the interest is so low and is less than what the inflation will change the power, the purchasing power of dollars over time at 3.5%, you're paying less on your interest, and so you keep more of your money. It's a chance. It is a great time to purchase a home if you're thinking about it. It's a great time if you're thinking about refinancing. Even if you've already refinanced in the last year or 2 years or 3 years, and you think, well, I think I've only refinanced once. No, consider it again. Most experts, loan experts would say, hey, if you can save yourself 1 percentage point or even close to 1 percentage point, you got to consider it. Obviously, you have to look at what are the costs or the closing costs to refinance or to purchase a home. But it's a great time. Interest rates are low. They're going to stay low until the economy rebounds, which could be the end of end of 2021, maybe a little sooner. But until the Federal Reserve sees consumption really pick back up and consumer spending really start to pick back up, and they start to get worried about inflation, they're going to keep it low, probably. Do avoid credit card debt. Credit card interest rates, conversely, are not at record lows. They haven't been. They've been high, and plus, even if they were low, here's the thing: the difference between buying a home or refinancing a home on a fixed loan, like a 15 or 20-year loan, and a credit card. Credit cards come with fixed interest rates until they notify you that they're going to change it. Credit card companies can change their interest rates, and they do when they so choose. There are also a lot of variable credit card interest rates. Avoid those always, because they do go up and down, and there are some cases when they will go down, but you don't know when they're going to go up or how far they're going to go up, and it will be unexpected. And the higher that interest rate goes, the larger your monthly payment, and the more expensive all purchases that you've made in the past become. Avoid credit card debt always. It's going to, even with low interest rates, those rates can change with notification. What about debt balances? Well, in 2020, you can see here that in 2020, just as we are going into the pandemic, our balances on debts were hitting all-time highs. We had a record high of just about every type of debt. You've got the mortgage, you've got the home equity lines of credit, you've got auto loans, which were really taking off. And then you've got credit card debt and student loan debt, which continues to skyrocket, it seems. And then just all sorts of other debts. These balances ran into stimulus checks. They had this collision. And that's what happened in 2020. We got those stimulus checks. An amazing amount of stimulus money came from the federal government, and a lot of people paid down their credit card debts. And that will continue as we move into 2021 and a new administration in the White House. There's talk of increasing, even as we have one stimulus check already this year, early 2021, we're looking at even increasing that further, possibilities. And Maybe not to the same extent, but generally American households will continue to use a large portion of that to pay down their debts, to put into savings, and not just to spend it. What that means is our debt balances are going to continue to go down as a whole. So what does this mean going forward, 2021? Onward and upward, we hope, right? We are all looking forward to coming out of this pandemic and out of the restrictions and everything else. Scores, let's talk about credit scores. These are all, I give these all as my opinion. These do not represent any guarantees, but this is my opinion. Scores, especially as the stimulus checks are hitting our bank accounts and a future stimulus check hits our bank accounts, we pay down even more debts, scores will continue to rise. The largest portion of improvement in our credit scores as a whole was in the utilization rate. That means based on what's your total possible balance on a credit card and how much of that are you using, the less that you are using, the better your credit score. So if you're here and you pay down that debt with the stimulus, it's going to improve your credit. But, and this is just an expectation, if it doesn't happen this year or early this year, it'll happen at some point. Things will start to normalize. And normalize when it comes to consumer credit means a lot of people get into problems with they get into too much debt, they start missing a lot more payments. There were a lot of programs, hardship programs that creditors put into place with the pandemic that allowed consumers to miss a payment or weren't getting reported as late payments. In fact, with student loans, they didn't have to make any payments at all. And mortgages, there was a lot of lenders that were in part of a government requirement that they couldn't foreclose on homes. As the economy picks up and those stipulations and those programs are phased out, we are going to see a return to, in fact, a pretty serious return to a lot of problems in a lot of households. This buy now, pay later, as it takes off, we're going to see it kind of offset that upward trend because people are going to get into more debt and then they're going to start pushing those debts toward collections. And collections, not the worst thing to happen on your credit report. That belongs to bankruptcy. It's not, and then foreclosures usually ends up having a second largest impact on our credit report. But collection accounts can have a pretty serious, you can drop 25, 30 points overnight by a single collection account. We will see skyrocketing spending typically when we come out of recessions. There's this pent-up demand for spending, and we haven't been able to spend during recessions, and then when we come out, we go and do it. Now, there's kind of a double whammy coming here. We still haven't seen that huge spending since going into the Great Recession in 2008, 2009, as we were going into that. This one, so much restrictions in our everyday life that we can all understand. We're going to want to go out and have some fun, or we're going to want to out and travel and do this and that. Everything that we've not been able to do for a year. This is going to happen, and spending will go up, and with spending comes overspending, and with overspending comes problems with our credit. Bankruptcies as lenders, mortgage lenders especially, and student loans, those programs, forgiveness programs, or the postponing of the required payments, those are going to be coming to an end. That's when bankruptcies and foreclosures will really start to hit. And we're going to see that affect our credit ratings as a whole. If you wouldn't mind, please, we'd love it if you would please like this webinar, subscribe to our channel, our YouTube channel, so you can be notified of upcoming webinars on everything from budgeting and credit to debt and savings and identity protection. Find more information on all things personal finance related that we do at moneyfit.org/academy. You can also find free courses and webinars there that are available 24/7. This webinar will be archived at our website, moneyfit.org/live, and you can find it there. If you would like a certificate for attending this webinar, go to moneyfit.org/live-cert, CERT. It'll ask you to put in your name, how you want it listed on your certificate, the email address you want it sent to, and then the passcode. It'll require this passcode, 21TRENDS, 21TRENDS. Do not capitalize, no capitals in trends, all lowercase. And you can download that certificate. Will be emailed to you immediately. Thank you for joining me today. Any questions, please do feel free to contact me there at my phone number and email address on the screen. We are happy to help and provide any education guidance that we can. Have yourself a great day.